the fact that to be overdrawn where you owe money to your company is it's not really a good place to be. There will be tax consequences as a result, and the reason why all that legislation was put in, where the Section 455 tax is put in, is in order for directors not to take advantage of that situation and use the companies like their own bank account, really take money in and out whenever they want without any consequences. So you have a temporary tax. It's meant to be temporary tax, Section 455, which you pay 32.5% on the tax when you take it out, and then when you repay the amount, you get that rebate. In tax investigations, and most of the time, what we have is a situation where the profits have been understated for whatever reason. Can be understated. Sales is just one example, but for whatever reason the profits have been understated. It's been established through the accounts, and what HMRC would ask is, where has the money gone? So you've taken money out from the sales, where has it actually gone? And if it can't be justified that it's being spent or incurred on purchases or expenses, and there's no audit trail, HMRC then will say, well, then we will assume the director has pocketed the money. They've taken it for their own use, for their own living expenses, because you have not been able to demonstrate that the money has gone elsewhere. Most of the time, you find in HMRC approach, sometimes they just do it as a default position. So that's when you would have to challenge that if there's evidence to demonstrate otherwise. The difficulty here, I find, is when you have a compliance checks or tax investigation, it's done in a particular period, and then you can have HMRC going back, applying the results of one compliance check to previous years. And then what you have is a situation where the accounts are virtually reconstructed several years after the fact. And so in hindsight, you will have an overdrawn director's loan account, and then you'll have a considerable Section 455 position,